This podcast is sponsored by Delupa. Delupa was founded by a former hedge fund analyst. He didn't have a tool that he trusted to be 99.9% accurate that allowed him to pull the updates directly into his existing models and that had the granularity and KPIs, guidance, and non-GAAP adjustments that he needed. So he built Delupa. Delupa is the fastest growing source for public company data, with data available for over 3,000 companies. Hundreds of AI algorithms collect and organize customized company historicals with an accuracy level and depth of data that is higher than anything achievable by other modeling tools. Each data point is audible to the source. Delupa's Excel plugin is the first to allow you to update your models in your existing format. It's simple and non-invasive. Delupa's clients are able to cover more opportunities and generate more ideas. No more data errors, no more Excel monkeying, just the fundamentals. See why equity investors are switching to Delupa. Visit delupa.com/YAVP. That's Delupa, DALOOPA.com/YAVP to learn more. All right. Hello. Welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, follow, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on, I believe for the third time, my friend, Chris McIntyre. Chris, how's it going?
Good, good. How about you?
Doing good, man. Excited to have you back. Let me start this podcast the way I do every podcast. First, a quick disclaimer to remind everyone that nothing on this podcast is investing advice. We're not financial advisors. Please do your own due diligence, consult a financial advisor, whatever you have to do. Let's jump right into the stock we're going to talk about on for the third time. The stock we're going to talk about, we started talking about doing a podcast on this in December, which might have been slightly more timely, but I still think, I mean, I know you would agree, it's still a super interesting company. I think there are some headwinds to maybe like the trading price that get resolved over time. I think there's a really interesting opportunity, but I'm putting words in your mouth. I'll just turn it over to you. The stock we're going to talk about today is Sotera Healthcare. The ticker there is SHC, and flip it over to you. What's so interesting about it?
So I think the high-level trader talk pitch for it is Sotera Healthcare is a high-quality business that had a legal liability that drove the stock down tremendously. So it was something like $30 a share almost in like early 2021. Exiting, I guess it was more like late 2020, or whatever exactly. It was $30 a share somewhere in that period. They had a legal liability that drove the stock all the way down to like $7 to $8 to start the year. It's now up 100% year to date. You and I were both involved before the 100% move. So just pointing that out.
You might have been involved a little bit heavier than I was. I was involved, but you were involved. And
yeah.
myself
But
yeah.
The kind of setup though was like, but so it's had this big reweighting, but behind it, like as much as we can say that the legal liability probably was exaggerated in the first place, it's very much a clearing event and it's a much cleaner, easier to understand story, but it still is not retraced all the way back to where it was. And underneath what you're getting is a super high quality compounding asset. It's a healthcare and market exposed stock without the risks that are, I think, are higher on most healthcare investors' lists, like payer risk and like product cycle and things like that. And so it's really like a stable 10 to 12% top line grower, 50% margins, no real economic cycle, and currently trading. We could talk exactly about what the right way to think about it was earnings versus EBITDA, but something like 12 times EBITDA. I would say something like 16 times real owners' earnings for an asset that like the comp group is more like, if I was thinking about like, most people that like listen to this podcast all the time, like, some sketchy special situation-y, off the beaten run kind of stuff. But like the comp group for an asset like this is really the stable Sycamore and IRA, typically trades 25, 30 times earning stocks, but they don't really ever stop growing because there's no real reason to expect it to stop. And so I think it's a really interesting opportunity to get long sort of a funky security that is actually just not that funky at this point and is just a really high quality business. And so what you do is you get to clip this sort of like 10 to 12% top line grower that theoretically at its current price would be a teens better IRR kind of setup with a strong, I think, reweight catalyst in the next 6 to 18 months, something like that, where it can get in line with the peer group. And so just as like an example, when all the post IPO like price targets came out and what people were using, people were slapping like 25 times EBITDA bull targets of like $50 a share exiting like 2023. We're at 16, 17. So we're nowhere near like what the bull of bulls would have thought about this asset before the legal liability started. And I think when you think about, I'll let you take over in a second. When you think about like the pitch, I think there really is like two different sides of the pitch. Like one is which is understanding the legal liabilities, where the simple pitches, they're kind of wrapped up and much easier, I think, to understand now. And then the second pitch is like, this is actually a really good business, and here's how it's going to grow and compound, and why it's going to grow and compound.
Perfect. So I think we'll revisit the legal in a little bit. I mean, if you and I again, if we had been doing this podcast 2 months ago, the legal would have been front and center, and then we would have talked business. At this point, the legal about to wrap up, as you said, the stock's up. It's more about understanding the business. So let's talk about why I don't know if this is the best business in the history of the world, but when I wrap up like the combination of the pricing power, the stickiness, the economic insensitivity, the moderate growth, like it actually kind of is hard for me to imagine that there's a better business than this once you wrap all those characteristics. So I want to ask you, like, what is the business and why do you and I both think this is such a good business?
So Sotera Healthcare is three separate kind of divisions that are somewhat related, but not totally related. But the main division, which is roughly say 70% of profits, and I think is the reason to be the most excited about the company. 70% of revenue, 70% of profits, right around there, that kind of general mix, maybe a little bit. The margins are slightly higher in the segment. But what it does is it owns Sterigenics. And so Sterigenics is an outsourced sterilizer of mainly med devices, but also some pharma and a little bit of other stuff. And so the simple high level pitch is what you get is med device growth, which is say like units 5, 6. So it's like a GDP 1.5 to kind of 2x growth story. So when people say like biomedical revolution, like we're all gonna have artificial limbs and live to be 300, I hope. That sort of like, above market secular growth story is med devices, right? The typical problem you have in med devices, though, are twofold. So there's some really interesting good things in med devices, but it becomes a much harder business to wrap your head around for two reasons. One, there's like payer risk. So the government, you know, is a huge supplier of insurance through Medicare and Medicaid, and sometimes they change the price. And so like overnight, sometimes you have these things where it comes in and it's like, by the way, we're paying 20% less. And so like,
Yep.
this is a difficult market. You also have like product risk, meaning, you know, what is the next gen heart stent going to be? And like, is this company going to execute or are they going to lose market share? And so these two things make this kind of space a little bit more, challenging to invest in.
And just throw one
Yeah.
more liability risk too, right? You mentioned
Yeah.
heart stents. It can turn out 2 years later, you find out, hey, every heart stent you did, you thought the battery lasted 5 years, it lasted 2 years, and you're massively liable for all these heart attacks, or there was some lead like you can invent a lot of different things. And you might laugh, but I can point you to several examples where companies have come and said, hey, turns out every installed product we've ever shipped is effective and we are going bankrupt because we have to pay all of these warrant liability claims.
Yep. Okay. So that's the difficulty in that space, right? But everyone's attracted to the space because of the above market growth and also because there's no real cycle, right? Like you need a heart stent, you need a emergency, surgery or whatever. Like it needs to happen and there's no economic cycle. And so you get the growth without any real,
Yep.
if interest rates move 2%, heart stent volumes will not matter. Like this, it doesn't matter.
Might go
Yeah,
up.
it's not-
You might give a couple people heart attacks and maybe you're
you
getting
might-
an
there you
increased yeah.
Yeah. But so because of that, that's like the challenge in the med device space. But what these guys do is they just sterilize the devices. And so I'll get into the algorithm in a second, but I'll explain what the sterilization
Perfect.
sort of process and what it looks like is. What happens is like this med device company, Johnson and Johnson, let's just say, Stryker, whoever exactly, makes these products, and then they need to get them to market. So they got to ship it to a doctor's office or a distributor or a hospital, wherever it's going, right? But before they do that, they have to prove to the FDA how they actually like made sure that there's not bugs all over this stuff. So just, bacteria, viruses, mold, whatever exactly, right? So what they do is they physically make the device, they load it on a truck, and then they drive it. They can either in-source sterilize it themselves, or the industry is roughly a little over 50% outsourced. And what they do is they drive it to one of either Steris, which is the other side of the duopoly, or
Yep.
Sotera's facilities. And in that facility, they sterilize it using either gamma rays or something called ethylene oxide, which we'll talk about later when we talk legal liabilities. And the device gets cleaned there, and basically it gets put back onto the truck. And then the med device company actually delivers it to the thing. So Sotera takes or Sterigenics specifically, takes no delivery risk. They take no product, like, is this a good product or a bad product, or is it going to lead market share? It takes none of that actual risk. And so as a duopoly setup market, They also don't have a real competition angle. And we can talk about why there's not competition in the space, but there's really only two players. And so what you get is you get med device growth, you get a little bit more trend towards outsourcing because the industry is, say, 55% outsourced or
Yep.
57% now. And a decade ago it was, say, 40%. I forget exactly the numbers, but that's roughly the ballpark. And so you get like a little bit extra unit growth from the outsourcing trend, and then they take 3 to 5% price. And it's just really one of these like clean businesses where it's very hard to see how that end market doesn't keep growing. And it's also very hard to see how competition would actually come in to serve these products. And so like some of like just the high level stats that I was going through before this that I just like, they have a 100% renewal rate with their top 10 customers or 25. I forget which one they disclose. Contract length is something like 3 to 5 years. Uh, 80% of their clients use more than one facility, and over 50% use five or more. So you're really built into these guys' networks. And the other thing to also think about is that, like, a heart stent, I looked it up. The average price of a heart stent is something like $1,300. It costs some agency that's trying to complain that hospitals jack up rates, put this statistic out there, right? You might be paying $1.70 to sterilize it. And so there's no real financial incentive for someone to switch sterilizers. You're built into their network, and so it's difficult. And on top of it, like you need to get FDA approval for how you're going to do it. And so one of the biggest problems is, for some of the, I forget which order is, there's a class 1, 2, and 3, like med devices. And I forget which one is the complicated one and which side is the less complicated, like gauze or, a syringe or something. But for any of the complicated ones, you are written for all of them, you're written into it. And for the complicated ones, you're written into it. And it takes 6 months minimum, if not a year plus, to actually switch suppliers, which has a twofold, we're getting into some details here, but like a twofold like benefit to the business, which is one, no one ever switches. And two, you need to offer redundancy if you want to bid for larger contracts. Or
Yep.
for, if I'm the CFO or I'm head of sterilization or whatever for Johnson & Johnson, I don't want to have 70 different contact people. Having one or two is ideal for me to simplify my world, right? And so there's really only two people. I mean, not really. There are only two people who can offer redundant things. And so the point being that, like, if there's an earthquake or a storm or a fire or something happens at one of the facilities that we are using to clean to sterilize our heart stents, written into the FDA approval will be the other backup alternative facilities that we can then ship product to, so we don't have to pull the product from market. And so if you're looking about it from the competition angle, if we get together and we raised $100 million to open, one of these facilities, right? Reality is like we're gonna have to bid for one contract maybe to start it, but we can't offer redundancy, and it just becomes this very complicated thing. And then also just to round out a little more on the contract side or the business side, they actually run Sotera, Sterigenics, runs the facilities basically 24/7. So like they take deliveries at like 3 a.m, like literally on Sundays, And the in-house provider, if you wanted to insource for Johnson & Johnson, we have stuff at our facilities, right? We are not going to be able to run those because we don't have the volumes to run them 24/7. So like not only is it more redundancy built into the network, it also is actually cheaper because they're going to have the same basic machinery running 24/7 instead of running 40% of the time. And
Yep.
so it's this very, you're basically like have like huge customer lock in, and like it's also cheaper, literally, probably. We'll see where pricing goes over a period of time and whatever. But like it's just this whole, it has just a great momentum around it and a lot of like barriers and moats. And so this business is one of the more bankable, I think, it's hard to know what'll happen in 10 years, but like that med devices are up, I think is highly probable. Like one of the
And that
highest.
we'll be sterilizing med devices is also highly probable.
Yeah, it's hard to imagine that we're not doing some version of all of this. And there's nothing happening that would delay the trajectory really of like this 10% top line growth. If anything, accelerating because of their current growth investments. But yeah.
That was an absolutely great overview. You hit on many of the angles that I wanted to in the Modi section. I mean, hopefully people, if they're listening, they can understand why we think it's such a good business, right? Because of everything you just said. But I just want to pull a little bit more on the why it's so hard for a new build competitor to come in, because I think this will also help us transition into a little bit of the growth and the growth CapEx angle. And it's, look, if you build a facility, it's all about utilization, right? So if you and I went and built a facility, or these guys are out there building new facilities right now, it's not just that you can't go to Johnson and Johnson and say, "Hey, all the gauze that you're giving, all the gauze or all the hips that you're getting sterilized at one of the Sterigenics facilities, switch them over to us." They can't do that because they'd have to interrupt their supply lines, get an FDA approval. It's not just that; it's that you have to go get new products. So you have to build out these things. So if we went and built something, we'd have zero capacity. So do you want to talk about how they kind of when they're doing their growth capex, how they get the facilities filled and how they know that that growth capex is going to have things to sterilize there? I think I kind of jumped into a few places, but I think you can see where I'm going.
Maybe I'm a little bit to me, like they basically like they build out a facility because they have all the relationships and all the network and everyone sort of knows them, and they're just like, because the industry is effectively sold out right now, and so there needs to be growth capex. So
So I
yeah.
guess where I was trying to go is when they say, "Hey, we're going to build a new facility," what they've done is they've pre-sold, and you can correct me if I'm wrong, or feel free to jump in at any time if I'm wrong. They basically pre-sold, I think it's 50% of the capacity before they even put boots in the ground, right? They've got Johnson
Yeah.
and Johnson, and they say, "Hey, it's 2023. We're going to start building a facility. It's going to come online in 2025. We think we can do 100,000 units per day in this facility. Will you take 10,000?" Johnson Johnson says yes. And before they even start building, they've got 50,000 units of the 100,000 sold. And I was saying, if you and I went and did that, like we wouldn't have the relationship. So we basically have to spec build a sterile facility because Johnson Johnson's not going to come and do it, like agree to future products with us. So that's kind of where I was driving at it. Maybe I was
Yeah.
just being a little bit too cavalier on it.
No, no, no. That's true. Like there, it's almost like I feel like I'm overselling by talking about like competition, which is like a weird way to phrase it. But like
Yeah.
we're like you're like dealing with like the very small amounts, right? So like there are like some startup X-ray facilities, which is like 1% of the market. So it's like a really tiny part of this market, right? So I know that they like what they yeah they try like the startup guys try to like find like a guy to have one contract to take 25% of volumes, but the reality is like it's hard. It's got to be super not that critical. You know what I mean? It's just and like there's also like on top of it, like when these guys do their growth capex, they absolutely are like it's booked. Like they book with enough room that they they have a plan for like how we're going to grow and expand our footprint over 5+ years, 10 years, whatever. But we're not executing on all the 10-year plan at the same time. So they absolutely are sold out to start. I mean, like the industry is actually really, really quite tight right here, which is why we can start talking about quarters at some point in this, but like it does sound like, if anything, the 10%, I think grew constant currency sales, I think like 10.4, 10.2 or something like that. Like if anything, I'm like, we could maybe get up towards like 13, 14 in like a couple of years, just price plus volume growth. But yeah, no, they're deeply sold out. The other thing to think about too, because I think a lot about like it's like that Buffett thing, like if you had $1 billion, could you get in or whatever size dollar amount saying, right? But like in this industry too, like if you think about it, it's extremely like niche. And so there's not that many people that actually are employed in it and have the knowledge to literally help you build it out. So even if we raised $1 billion and we were going to build 10 plants on spec or 12 or whatever that math comes out to. I know that Sotera says they can build 1.40 billion, but like we might not be as good at it and whatever you want to talk about. But even if you could do it, which is like a long shot, moonshot pitch with you know what I mean? Like it's hard to see how it would happen. I don't know that you could literally staff the facilities to create the third you know what I mean? Like it's just, there's not really, it might be, it feels like a impossible task and it might literally be an impossible task to actually do it.
And as you said, like Johnson Johnson, the cost of this thing is $1, right? How are we going to get them to commit to us where we're going to go, "Hey, you're sterilizing stuff for $1 per unit. We'll do it for 95 cents." And Johnson Johnson, it's that famous thing. "Oh yeah, we're saving money on safety." Like sterilization, the saving 5 cents per unit on $1,000 unit is absolutely nothing. But the downsides of we ship it to Chris and Andrew's bootleg sterilization and they can't get it done, so we're not selling these $1,000 units. Or even worse, they forget to sterilize it and there's a hip implant into somebody that's got bacteria on it. Like it's just
Yeah.
one of those things, the downside versus the upside versus the cost. It's going to be really hard unless Chris and Andrew have a lot of background and a lot of money. Just going to be really hard to get somebody to agree to go to a new startup competitor.
Yeah. Which is why it seems like a pretty cushy duopoly.
Yep.
So
So let's talk about I think if I'm trying to remember the quote from the Q4 call, but they said, hey, since I think the CEO said, since I got here in 2006, we've got like 15 years track record of mid single digit plus organic growth. I think their long term algorithm, if you will, is about 10% growth coming from some pricing and some volume. Do you want to talk about just that 10% growth, the pricing, the volume, particularly I think the pricing, because that's the most interesting part of the story.
Yeah, so like, um, so they say they give blended guidance across the three segments when they say pricing, right? Because they guide to like 3 to 5% pricing, with like one of the segments being at the high end, one of the other segments being at the low end, and Stargenics being in the middle. We should talk about the other segments at some point, but they're good, but not nearly as interesting. Um, but I think that the argument around pricing is really, which ties into the legal liability, is look, there's a capacity shortage because of some of the legal liability stuff on ethylene oxide, which is half of the industry, let's say, and it's half the industry. Um, because of that legal liability, like there's just going to be a real hesitance to see any more insourcing, and there's going to be, if anything, an acceleration towards outsourcing. So like capacity constrained, more demand than ever, two players, regulatory burden going up equals better pricing over time. Like it's not much more sophisticated a thought than that. We'll see exactly how it rolls through. I think to them, they want to keep their relationships on the right pace. So I don't like anticipate them jacking prices 10% and inviting turmoil into their, they might be able to. But to me, I'm like, I think if anything, like you could definitely see over time. I mean, if you do the consultant calls, right? Like it's all like people are like, yeah, no one wants to do this anymore, and they're happy to pay the 2 cents extra to not run the legal liabilities. Because if you think about it, like the quote, like like, does it make your beer better, right? Like the Anheuser Busch, which Amazon loves, but like sterilizing a heart stent in-house, excuse me, by Johnson Johnson's not their core competency. They don't know about it. There's these lawsuits, that these guys, Sotera just had to pay $408 million for. Like, there's not a whole lot of reason to push back on price, and there's not any real competition. And so I'd absolutely think over time, pricing going up is part of the story.
Yep.
You don't have to, at this price, you don't have to believe that to get long it, but like it's definitely a part of the story.
So I think some of the pushback, I mean, a year ago, the pushback would have been, hey, they lost the legal case. And we'll get to the legal case in a second because it is important to the go forward story. But some of the pushback a year ago would have been they lost the legal case and bankruptcy, turmoil, all this sort of stuff. I think the first pushback a lot of people would have when they look at this idea is they're going to say, all right, Andrew, Chris, great. I'm convinced this is a really good story. It's a really good business, but it's trading low teens EBITDA. I'm kind of looking at my 2020 numbers, about 20 times unlevered free cash flow. There is some growth capex in there we can talk about, but people might say, hey, Andrew, Chris, this isn't early 2021 anymore, right? 20 times unlevered free cash flow for a great company like that's about fairish. And so people would probably say more, what's the opportunity cost of me buying this versus something else? Am I really going to generate a lot of alpha at kind of that valuation? How would you talk to people about that?
I think you have to like, so if the way I point people towards like two directions, one of which is like, okay, so walking through that math, this is roughly speaking like trading at a market multiple, give or take, right? Stock market does not have a 50% operating margin with 10% top line growth and no discernible earnings cycle. Like that is not what the US stock market looks like.
Yep.
So on a pure long, short, paired off, market neutral, beta, whatever you want to call it, book, right? Like long $100 is Sotera at short $100 is SPY, I think is an absolute alpha value add trade, right? Just alone that. The second thing I point people towards, 10% top line growth and 50+% operating margins is Visa. And let's call Visa, MasterCard like the everyone agrees are great businesses that grow forever, and we all understand why, because we're going from cash to not cash, right? Like it's not, with no competition for those two guys. I think Visa trades like right now, like something I haven't written down over here. It trades, I believe it's like 28 times forward and like 20 plus times EBITDA. Their margins are slightly higher. They're like 65% or something. But like that's kind of the thing. And so I think a lot of guys who spend some time looking at off the run sort of value stuff, like end up looking at like companies that aren't nearly as high quality as this, right? And so it clouds like a lens because you're like, well, why wouldn't I can buy this like offshore oil servicer for 3 times EBITDA, and you're like,
Hey, Chris, come on. Don't call anybody out on the
I'm not
podcast.
calling anyone out on. I own Polaris at a point. But like, this is not a business that's going to see like down 50 EBITDA every now and then. Like, you know what I mean? That's not part of this business. And so the peer group for this to me is like, Moody's, Cintas,
Yep.
Ecolabs, Rollins, like these, Eurofins, which is it's a very comparable story, actually trades in Europe, but Eurofins has a margin issue in it. But like, there's a company called Stericycle. Like, go look at these. Like, sure, Stericycle ran out of growth as part of their problem, but like these things can compound at a high rate for a long period of time because they're growing revenues 10+%, and they're also not the hyper growth ones where like there's going to be a rapid competition out of nowhere, right? Like, this is not. You're not going to have a TikTok show up out of nowhere and just blow up potentially the market. And we're like, oh, I thought there were 3 players. Now there's 4. Like, that's not like what's going to happen here. This is a slower, but still well above GDP growth kind of company. And so to me, the right peer group is there. And then I think it's very, very likely you will ultimately reweight towards like 25 plus times earnings. I think that's like a very high probability bet. So part of my thesis is making that bet. But even if it weren't, I'm like, I mean, I go to sleep. We can talk about what I go to sleep at night feeling safe about or whatever. However, I'm supposed to be phrasing that. But like, this is definitely not a business that like anything happening in the world is going to like freak you out about what is actually happening here and is this business going to implode or anything like that. It's not one of those businesses, and so I am absolutely just happy to sit here and clip my 5% or what 6%, let's say, levered free cash flow return plus my 11% top line growth or
And
EBIT growth, whatever you want to say.
one of the things you said in there, like this is trading at about average market multiple. As you said, like a Visa or a MasterCard trade for 5x the multiple, five extra turns of the multiple ish that these guys trade for. Marriott and Hilton, probably the same thing. And like Marriott and Hilton have economic sensitivity, and there's the risk, a few years ago, everybody was worried Airbnb was going to take them down. They're competing in a oligopoly, not a duopoly. Visa and MasterCard, 18 months ago, everybody said Bitcoin and all these crypto players are going to come from, like, there is some technological risk with SHC, with serialization, like as you laid out, duopoly, these things are locked in. It's really hard to say that there's any technological risk. I know some people have talked about some things, but like there's a reason we use ethylene oxide. It's very difficult to sterilize a lot of these things in mass as cheaply as we do. It's hard, just hard to see any way this business goes away. And as you said, like if all of that takes care of the downside and the upside is you've got a 5 or 6% bond that's growing 10% plus, some of that, I said unlevered free cash flow, that's all the CapEx they're going to do this year. They're investing capital. We can talk about how good the returns on capital they think when they build a new facility, how that drives growth. Like that's a pretty nice, the downside's taken care of. So there should be pretty good upside over there.
Yeah, I think that's right. Someone commenting on Twitter, who obviously had done work, right, had like a nice little blurb about it, but talking about like, well, if ethylene oxide gets replaced, and it's like, but even it's like all those scenarios are like minimum a decade. Like,
Yeah.
it's not there's no rapid change happening here, unless a miracle occurs. Like, it's not there's not a whatever you think about like Visa and MasterCard, there are tons of players in payments and tons of turnover and tons of little parts that are changing at any given time and lots of growth capex going into it for venture capital dollars or however you want to phrase it. Like, those markets are inherently much more competitive than what you're looking at here, which is, there's not a lot of demand for a third player and there's almost no scenario that a third player comes along. There's just it took a long time for this industry to evolve in this way. And it's kind of like one of those things where like it's sort of like Moody's, right? Where it's like, I don't know that it's this is actually worse because I actually don't think there's any real argument that Sotera and Steris are like bad or anything like that. But like Moody's people are like, maybe it could be a better system, but like it's hard to imagine anything replacing it now. And so that's where we're going with. Like, you know
Yep.
what I mean? And so there's just not, it's hard to really imagine how something comes in, which is very valuable commodity in my opinion. And so like I understand people not willing to bank on 25x plus earnings multiples, right? And frankly, like if this thing reweights to 30x tomorrow, like McIntyre Partnerships has several shares for sale for anyone looking to purchase at that price. But like, you know, it's just a rare commodity. And it's very rare, I think, to get a shot at these sort of type businesses like at anything resembling a reasonable multiple.
Yep.
Like it is, you almost always have to pay up for it. And so what you end up injecting when you have that strategy is you end up injecting one, it lowers the return because the capital returns are inherently lower by being at a higher multiple. And then two, like if you get it wrong, you lose a lot more money. You know, like that's the problem is like, oh, we buy something at 35x and it turns out that like there's actually a pricing problem and suddenly it's like 14x. You're like, okay, that's like a down 60 on a downer. You know what I mean? Like, that's a huge blow up. With steroids, I mean, even like, was it going to trade like commodity chemical multiples like 12x? Like where is, you know what I mean? Like what, why would, okay. You know, so I just think it's as much as it's up, and I appreciate that people don't like to buy things up. That's like the opportunity is like people don't like to buy things up, and that's why it's still attractive.
I agree. And I think there's also, look, when the legal liability was out there, it was very difficult for anybody who wanted to buy a great business to be here, because we should start shifting and talking about the legal liability.
Yeah.
But a couple months ago, you had to be a legal analyst to be involved here. Now, even though it's 2 months after the decision, the settlement got made, like, I do think there's still, if you're looking to invest in a great company, you probably want the settlement to be completely done, not 99% done. And we'll talk about completely done in a second. But B, there's still probably a flip of the people who bought the shares like at the height of the crisis. There's still probably some shares to get sold. This stock, we should probably talk about ownership, is only 33% or so of it floats. So, maybe the largest fundamental guys, this isn't the top of their list. They'll get around to it eventually. So I still think you've got a tailwind as the hands transition to where they should go. But so let's switch over to the legal liabilities. We've alluded to them a lot. Why don't you give a brief background of what these are, what happened, how this resolved earlier this year, and what this looks like going forward?
Sure. So do you think I should do like the historical perspective on how we got here, or should I do like an asset by asset? What do you think?
We probably don't need to start in the 80s asset by asset, but probably just focus like, what the government said a few years ago, how that impacted
Sure.
Illinois, and what happened last year and this year.
Sure. So ethylene oxide is one of the ways that they sterilize stuff. The other stuff ways are gamma rays, which is they they make pencils with that you take the tip off and it blasts radiation at it, and they like run a conveyor belt under them. Right, literally kind of what you're doing. And then you have ethylene oxide. You also have E-beam, which is kind of the same thing as gamma ray. And then you have ethylene oxide, which is a gas that you basically, what you do is you take a pallet of whatever med device, you stick it in a chamber, you close the doors, you fill it with, I believe actually they fill it with like nitrogen, and then they insert a little ethylene
Yep.
oxide gas into the chamber. And the ethylene oxide is so ethylene oxide is like it's like a pesticide. It's a toxic gas that kills things, right? And so you stick it in the chamber, and it's really useful because it goes through plastic packaging. Why am I still giving the fundamentals? We're on the legal stuff. Uh, but like you fill the chamber with it, and then you let the gas burn off, and then you take the stuff out, and it's clean. Um, what happens is ethylene oxide is a known carcinogen. Like it's a dangerous substance. You use it to kill stuff, right? And so people study this stuff for all the time. So there's all kinds of OSHA guidelines around like what are the hours, how much exposure do you have, how do you clean it, and it's mainly that study for the whole history of the industry has been focused on safety for workers, right? It's
Yep.
also explosive too. So like there's a lot of rules and regulations trying to protect people from using stuff.
And just going back, when we talked about what a good business is, we didn't talk about, hey, they're dealing with the carcinogen explosive poison. Like
Yeah.
those all, that adds a lot of regulatory burden, that increases the moat, where Chris and Andrew probably aren't going to be able to start up a business
Yeah.
competing with these guys.
Yeah, exactly. What also happens though is in the background of that is some of the ethylene oxide ends up emitted into the air around the facilities, right? Um, and ethylene oxide is naturally occurring, actually. So it's in particularly like say exhaust fumes. Um, so I'll put a pin right here in this moment. So just you and I, you're in Manhattan, right? So
Yep.
yeah. So we're actually being exposed to more ethylene oxide than the people in this lawsuit were exposed to. Just as a side note, just this is pin, I'll take the pin out right there. Just but so it's naturally occurring, it's all around. So there's always a background level of ethylene oxide. But over time, the EPA, who's very concerned with all carcinogens, right? Like this is obviously something you'd be looking at, and has, thankfully, we live in a country that has good safety ratings, right? Like no one wants poisoned water, no one wants poisoned, all that kind of stuff. But what they did is in 2016, they did a study, and they basically put out, and they tried to conduct an estimate of expected cancer cases due to ethylene oxide in the environment around certain facilities, right? And we can talk about the study in a second, but what it did is it effectively kind of like put notice that like, hey, maybe we need some stricter safety ratings around emissions from these plants. And I think it kicked off, I forget the exact number of plants that it said had an issue, but of Sotera's at the time's 8 ethylene oxide plants, 3 of them were on the list that said it had an issue, right? And it's worth just putting a pin there. Like they have subsequently like put out further notice and all that kind of stuff. And the other 5 facilities of Sterigenics that use ethylene oxide have remained not on the list of problems. But it hit these 3 facilities, right? One of which is in Illinois, one of which was in Georgia, one of which is in New Mexico. And so because of that, and so there was a CDC study on top of it, ignoring whatever that is. Um, because of that, it started litigation at those 3 facilities. And in particular, what you ran into is personal injury litigation and mass tort personal injury litigation. And I do a good amount of legal liability work as the fun, right? And so of all of the legal liabilities out there, personal injury mass tort litigation is by far like the most potentially explosive litigation. Because reality is once you get in front of a jury and you have someone who seems very sympathetic who something bad happened to, and then you have the big mean company who has the emails that are bad, it starts off a whole thing. And so what ended up happening though is they had a personal injury litigation advance in Illinois. They had personal injury litigation that will advance in the future in Georgia. And then in New Mexico, the plant is in the middle of the desert, so there's no one to sue them. And so there's regulatory actions around the New Mexico plant. But don't, for now, it's not going to
Yep.
surprise to some enormous thing. So for now, just leave New Mexico alone. So what the main issues were the plant in Illinois and the plant in Georgia. And the difference between the 2 plants has everything to do with Illinois being the most basically punitive, the most plaintiff-friendly jurisdiction in America. So as I like to phrase to people, the issue is really not the science behind what actually it said. Hence, like, go back to the pin that you and I are being exposed to more ethylene oxide right at this moment than this plant was actually spewing into the environment around there. So it's really not a matter of like science and all this kind of stuff. And if you want to go for people who are like, hey, that doesn't sound right, the EPA has like webinars where like they're like, because they put this stuff out and they know that it freak neighborhoods out. And so like you can go watch people from the EPA who are making these rules be like, 40% of people get cancer lifetime exposure. If 1 in 100,000 people gets cancer in addition, you're really talking about an extremely low threshold that we're at, right? Like they're not like that concerned about it. They're like, don't eat red meat. Like that's like higher, way higher on the list in this facility, right?
If I
But
remember
yeah,
correctly, the EPA and what they said was the people around Willowbrook, like it might have caused like 1 extra cancer case every 3 years for all around Willowbrook, if I'm remembering correctly. And that
yeah,
that was like
something like that.
within the realm of rounding error. So it was like very shoddy science on that. But yeah.
Yeah. So it's really it's to understand. Just talk about the science for half a second. Like the EPA is not like going like, hey, is this like 50% safe or is this 70% safe? They're going, is this 99.9999% safe or is this 99.9999999% safe, right? We're not interested in the 40, 60, 80% safe realm, right? Those are non-starters. So because of that, they conduct theoretical experiments that are obviously and intentionally completely unrealistic because we're trying to be extra, extra safe. So, for instance, the study as a base level, it assumes that someone's. So, what they did is they collected 35 air samples to measure how much ethylene oxide is coming out of the plant, and then they only used the 2 highest concentrations. The 2 highest concentrations occurred on days when the wind wasn't blowing because it's a gas, so it blows off immediately, right? So they used the 2 highest samples, and then they conducted a study thinking, what would happen to someone who lived there for 70 years from birth till 70, 24/7, 365? No one has ever lived in a single place for 365 days a year, 24/7, for 70 years, and the wind never blew. It's an obviously and intentionally ridiculous kind of threshold to make sure we're extra, extra safe. And what they're looking for is like, hey, maybe this is on the border. Hey, could you guys like spend like $10 million extra and just make this extra safer? And
Yeah.
like that's like the regulatory burden. They're not like, oh my God, this is asbestos and like we're actually killing people. That is not what we're talking about. But what happens is this gets in the hands of personal injury litigation, and we can talk about what mass tort personal injury litigation looks like in the US, but it's this whole big industry, the highest paid lawyers, and no other country really has a lawyer that makes $100 million a year. But in America, being a lawyer at points is an entrepreneurial endeavor, not a civil servant endeavor. And so it is what it is. And Illinois is basically one of the most plaintiff friendly jurisdictions. And so what ended up happening is these cases, despite the sort of weak science, in Illinois, you're allowed to assert a single molecule could have caused your cancer, which of course a single molecule could never have caused your cancer. That's not at all how that works. But you're allowed to say it to a jury, and it's what it is, right?
When,
But
when
the
I was
reality is, yeah,
I was just when I was doing the research here, and I think it's not just Illinois, but this particular jurisdiction within Illinois is the most plaintiff friendly in the nation, I think. And if I remember correctly, one of the quotes I heard when I was doing research was somebody said, "Look, I've worked with insurance brokers, and there's only one rule they have: we will not write insurance within it was Cook County, if I remember correctly. We
yeah,
will not write it within Cook County, Illinois, because the jurisdiction is just too plaintiff friendly. We just can't write it there." So like they're willing to underwrite, like water parks for drunk people. Like they'll underwrite that just fine. They just won't underwrite Cook County, Illinois, because the rules are so bad there. So just to put in perspective, like kind of what jurisdiction you're dealing with, I guess.
yeah, exactly. And it's why like the easy way to deal with it is just to zoom out. And you're like, look, it is a Cook County. If you get it to, so the specific thing is causality, which we'll talk about. We should actually talk about. But like, if you get it to jury um, in that jurisdiction, it is a problem. It's just what it is. It has nothing to do with the science. It has nothing to do with truth. It has everything to do with how it works in Illinois. Um, and so specifically though, there's two plants left, right? And so the Illinois plant, the simple way to wrap it up there is like they settle. And so the settlement came in, and this is like I think people who weren't as familiar with these kind of liabilities before were very worried about these explosive outcome kind of scenarios. And the reality is like there are reasonably well settled ranges for where these things tend to come out. Um,
Can I
and
put
it, yeah,
they do settle, but can I put they lose their first case, right? For about
mm,
the
yeah,
ruling is about 350 million. And that's when the stock falls off a cliff because they lose one case. They've got call it 1,000 cases to round up outstanding left. And people quickly start doing the math and say, if every case they're going to lose for 100 million, 200 million, 300 million times 1,000 cases, not only would this company be bankrupt, but every company in America would basically be bankrupt facing that liability.
yeah.
So they lose that case. They win their second case. They take the first loss, the second win, and earlier this year they announced the settlement for 400 plus million. And then I'll flip it over to you to kind of start talking about the settlement.
Yeah, yeah. So they announced the settlement. Very specifically, I think it's worth just is it worth mentioning the appeal bond? Well, might as well. I'm talking about it already. So they had an appeal bond, and so very much the timing of it is look, they had to post 150% of the judgment, which would be roughly $500 million at like say like 10% interest, whatever, just to make simple math. So we're going to do this for 2 years. So suddenly we're like we're going to have to pay like 50 to $100 million in like interest to settle this case.
Yep.
The overall settlement's $400 million. You start kind of staring at the numbers and you're like, how much is this worth really to fight? Right. And
Mhm.
so one of the things that the plaintiff's attorneys, if you're ever involved in litigation, figure out how much money it'll cost the other side to fight you is like a huge part of the battle. And so it just made sense that they were like, hey, do you really want to go down this path? Or can we let's just admit that like we're not going to get out of like Sotera at this point, we're not getting out of this for less than 200 million bucks. It's what it is. Let's just get it done. And like, maybe we paid so Terrace pay maybe the high end of like typical settlements, but like not the high end, but the high end of like let's say not specifically asbestos cancer settlements, right? But whatever, it's not that much money. We're talking about $40 million is a lot of money, a lot of money. But we're talking about like 1 year's free cash flow. And so ultimately, if we're squabbling over like a quarter's free cash flow is the bid ask between the plaintiffs and the defendants, it was like let's just get this done and get this story back on the road, right? So they hit the bid, and that's where we're at, right? And so talking about Illinois, the steps left are actually settling the case. Um, I think there's actually a chance you get paid on the settlement finalizing. The settlement finalizing is an interesting catalyst, I think, because people are like, "Oh my God, they have to get 99% approval," and it's like the Sotera. It was
Can
like
I
you need to get 99% because like that's sorry. Go ahead.
let me just pause you there because we haven't said what that 99% approval is. So they announced the settlement in January and they say, hey, we're paying it's a little over $400 million to settle the cases. And one of the clauses in that settlement is, hey, in order for this settlement to be in play, we have to settle, as you said, 99% of the plaintiffs have to opt into this thing. I think it's there can only be 12 cases that don't opt into the settlement. If more than 12 cases don't opt in, Sotera has the right to break the settlement, not the plaintiff. So Sotera can look and say, oh, it was 13. Okay, we'll take that. Or they can look and say, it was 13, it was 20, it was 100. We're out. Not enough of these cases have settled. So please continue.
Yeah, exactly. So it's this weird. It's a weird catalyst where like it's the reason you settled is because of the one case that had the $500 million appeal bond. And
Yep.
so the way it also works in these cases is the plaintiffs pick the order, right? So from a factual standpoint, the plaintiffs won their first case for a massive number and lost their second best case, right? So with that kind of hit ratio, the bottom 50% of cases are pretty, they're not going to be what you want to take to court, right? And so the point is that, like, in the, I think, unlikely scenario that the settlement breaks, they've already settled the top cases. So what will be left is actually a much weaker batch of cases, which is why I am sure the plaintiffs' attorneys are informing their clients, you're probably going to get much less than this if you actually go to court, and it'll take a long time, which is why ultimately they are pretty good at getting people to settle. So I think the most likely scenario that is that it settles. If it were not to settle, it is the funniest thing. I was saying it's a funny catalyst because the stock is likely down, and it is almost unquestionably an EV positive announcement. It's like a
Yep.
fun. It has this little duality. So I think it's worth like paying attention to see if the settlement doesn't get to these things. I mean, it's obviously worth paying attention to home, but like, so think about it. It's very likely to work out with the settlement. And the reality is, if they don't get 99%, it's likely that the settlement will still occur at a lower number relatively quickly after it breaks. So it
But it
wouldn't
will be
work.
a headache. It will certainly
Yeah.
be a headache.
It will be a headache. And if it were to occur, it's a buying opportunity, in my opinion. Um, but that's basically once you have done that settlement, there will in the future, as people develop cancer in the future in this area, like there's really the two cancers of breast cancer and blood cancers. And so there will be future cases, but like the farther out you get from like having been exposed in the 80s when it was a more at risk, the weaker the cases get over time. And also, you're talking about probably like I would say it's I think 10 or 20 cases a year would be like a good higher kind of like, think about that. Like the real settlement average underneath is probably $400,000. This company does like $600 million a year of EBITDA, let's say, like fast forward 1 year. So you're like, we're not really talking about a needle moving number of cases, right? Like this is going to be a small trickle future problem, not exactly sure what's going to happen. So while the litigation will continue, the bulk of it has been settled. Like 99% of it has been settled, right?
I think we've hit the Illinois
Mhm.
one well. You talked about New Mexico. There's not a lot going there. I do think a couple of people who've looked at the stock, maybe haven't fully dove in, they look and say, all right, well, they settled in Illinois, but there's still several cases outstanding in Georgia. And I think
Mhm.
both you and I think, hey, Georgia, yeah, they're probably going to lose some money there, but the Georgia, it is not a big concern, right? The headline number for Illinois was the first case they lost for like, I think it was 360 million all in. That's not going to happen in Georgia. I think they're going to be fine in Georgia, but why don't you just quickly address the Georgia risk here?
So Georgia, so the big one of the things that makes Illinois plaintiff friendly, which does not work in Georgia, is that in Illinois they allow you to go to court alleging one molecule can cause it, right? So the point is that like you have a carcinogen and you establish that it can cause cancer. You then have to show how it did cause it. It's called causality. Like, okay, this causes cancer. How did it cause your cancer? So there's causality generally, and then there's causality specifically, like your specific cancer. In Illinois, you can be like, one molecule did it. So it's like there's no real like we can talk about what science you get to prevent, but like at terms you're going to have to go to court basically because if that's good enough to get to court, we're getting to court on any of these things, right? in federal cases, I believe it's called Daubert, is how you set up causality. So it's not enough to say it caused my cancer. You have to explain to me how it caused my cancer. And there's no studies that explain to you how it caused cancer. So like ethylene oxide litigation has been thrown out several times in federal courts because of it doesn't meet the next standard to actually go to trial. Um, Georgia law is much more similar to federal law than to Illinois law. And so it is going to be harder for those 300 cases in Georgia to actually get to court. So I would surprised, nothing about it will surprise me, but like I definitely think the odds are over 50%. They actually don't even end up getting into court because I think they're gonna just you saw for people who kind of follow the news on this, was it Zantac where like the judge, there was like whatever that case is, the judge was like,
Yep.
you don't have enough stuff to go to court. Because the reality is once you go to court, it's sort of like this play where there's like you present an expert, we present an expert, and we act like it's 50-50. But if the actual evidence is like 90-10, putting two people in the stand is inherently unfair to like the defendant, right? Because it's like this is already misrepresenting what the odds are, right? So that's why like I think it's unlikely to go to court in Georgia. There's only 300 cases in Georgia, and the other interesting thing is that Georgia has the $250,000 cap on
Yep.
punitive
Yep.
damages. There are some people will look at it and there are cases that are bigger, but I think Georgia, the three standards are you can't be drunk, which doesn't apply here. You can't be intentional, which is like I stabbed someone to death, so it's not apply here. And then the other one is a product liability, and there's no product that we're talking about. It's the emissions, not the actual product.
Yep.
So there's an absolute cap on punitive damages that will apply here, and so you know it's just not going to turn into. They're not going to get $400,000 a case.
It's
They're going to
funny
get
'cause
legal fees.
it's
If they
funny
get to
'cause
court, they'll get legal fees.
when we started this, we were like, we're briefly going to address the legal case, and then of course, the legal case. I think it's also because both you and I get a little excited remembering the diligence on it, but we
Yeah.
spent 20 minutes on the legal case. So look, at this point, I think hopefully we've addressed a few things. We've talked about multiple. We've talked about business quality. I think if I had to sum up those, I'd say this is a fantastic top 1% style business at a market multiple price. We've talked about the legal cases and how there are some catalysts to putting those behind them. The settlement getting finalized in May or June. The Georgia cases hopefully getting dismissed. I think we've talked about all those. I just want to talk a little bit about the go for it, right? Like it's entirely possible you and I are just sitting here holding our Sotera shares, and for the next, 10 years, for the next 3 years, we're just compounding and the market multiple keeps expanding. But there's a couple other catalysts here. So I want to talk about those. Lawsuits getting dismissed, but the main one I look is I say, hey, the private equity owners here still own about 67% of the company. I think they've been involved in Sotera for about 10 years at this point. And you have to look at that ownership, the fact the company IPO'd a few years ago, and say, hey, they probably want to exit at some point. So, is there a catalyst around the private equity exiting? Is there, a strategic merger or selling this to a private equity company? These guys just tendering for a bunch of shares. I don't know, but talk about that stuff.
Yeah, I think like you certainly have an aligned ownership and board structure, right? Like it's a controlled company. The two owners, I believe it's like roughly 60% still owned by the private equity firms GTCR and Warburg. Top tier, well respected, intelligent private equity ownership. It's not yoo-hoos or whatever the term. And so you have a very good setup in that like the people in charge of the stock understand it. We talked a little bit before we hopped on the call about how like the background checks are that like they intended actually to sell this to another private equity firm. But because of the legal liabilities, it's just an awkward spot to sell 100% of the business to someone, so they IPO'd it instead. So the point being that like
No smart,
yeah,
no sophisticated buyer will take the whole thing. So maybe sell a
yeah,
chunk of it to unsophisticated buyers.
yeah. But so it's a very so the point being that like it was likely already shopped, so there's plenty of people already familiar with the asset. It's a very leverageable asset. Um, it sucks a little for the private equity guys because you're going to have to pay a high EBITDA multiple, so you're going to have to put a bunch of equity. But you can throw 7 turns of leverage on this company without a problem.
It's
That's
been
like
7.5 times levered. I
oh,
mean, before the IPO, it was right.
yeah, it was for the most of its history. It's been 7.5 times leverage without really any problem because it grows and doesn't have any cycle. So like, what's going to happen? So it's a very private equity attractive story. I think the setup from here is these guys, private equity firms, they know how to get this is not a IR department that like just got hired out of nowhere, right? Like they know that they got to find guys that know how to tell the story to people and explain to people and find the pitch and go to the right conferences. They have all the right sell side coverage. Like it's not an orphaned weird asset. And so, I think the story for here is, they have to pay down a little bit of debt because of the settlement funding this year. So it's a little bit of a weird uptick that this year's free cash flow isn't around. But like, 12 months forward, it's going to be buybacks. I mean, dividend, whatever you want to talk about with like their cash, M&A, whatever exactly it is. It kind of depends how the stock trades. But it is not one of these things where I think like if 2 years from now the stock is at the same price, that like you're just gonna like wait it out and see what happens. Like I think you're gonna absolutely see these guys put this thing up for sale if it's not gonna happen in the public market. And
And
so
it's 550 of EBITDA this year. 2 years from now, it's almost unthinkable that EBITDA wouldn't be 600 or 650 or something, and that's ignoring M&A. I just wanted to briefly touch on M&A. This is a 55 to 60% outsourced business. It's been in private equity hands a lot. That outsourcing rate increases, and it's kind of a duopoly. Though there are some smaller players out there. And M&A, I mean, I think the other thing, the reason private equities love this so much is, and management talks about it, they clearly want to do M&A. M&A has been in their genes, and I think M&A can be really, really interesting here. Do you want to just talk about the bolt-on possibilities and why that kind of is good for these guys?
sure. So there's two other divisions, one of which is Nordian, which is basically a monopoly supplier of cobalt. I'll just very, very quickly hit on it. The barrier to entry there is you have to talk someone into putting a new thing that could blow up a nuclear reactor. So there's no competition whatsoever for that thing. It's a nice little business, grows like 10% top line too. Say that's like 10% of EBITDA. And then Nelson Labs is or 15%. And Nelson Labs is the other third division, which is about 15% of EBITDA also. And it's really the M&A story for this business. It's where they want to direct the most of their M&A. And what they do is they are having a little bit of a cost versus revenue thing. And so it's a very minor part of the story, in my opinion, frankly. But like another little part of the story is like you should see a normalization in that business. But like what they're trying to do in that segment is they're basically trying to say that, so what Nelson does is it does, you want to make a heart stent, okay, but you want to use a new plastic. How do you get that through FDA approval? And Nelson does everything from like providing, consulting on like this is what the FDA is looking at now. Here's where we're at. To like we're going to take a rat and sew a piece of the plastic into the rat and like let it live for a couple weeks and then break its neck and look at what happened to the rat. Like that's what we do. And so that's kind of what it does. But it's a pretty niche kind of thing. And again, it's just like the pitch is that it's like sterilization 20 years ago, where it's like, does it make your beer better? No, this is not an area that you guys really know about. Outsource to us. We're on top of the science. We're on top of the stuff. We're on top of what the FDA wants.
And hey, J&J, do you want the headlines? J&J breaks 5 rats' necks during testing for a device. Give that reputational risk to us.
Yeah, exactly. So you just sort of play it off. And there's a lot of smaller players out there that kind of do this stuff. And so like there's an opportunity to like roll it out and build this business. And also while you're building the business with M&A, also grow your share with the companies, because like the more bulk you have, the easier the contract is, the easier, do you really want to have this in-house? Do it outsource? So, you know what I mean? So it has this nice kind of thing. And frankly, a lot of the customers, I mean, almost all the customers are the same customers that Sterigenics has. So there's a complete overlap. They have separate right now, which is important for the legal liability. They had separate go-to-market kind of thing. So they really are two separate businesses inside it. It's definitely a holding company, two separate businesses, but there's a very obvious overlap in that, like, they basically sell to almost the same exact department inside like the med device companies. And so I think like over time, they've done well on acquisitions in the past. Right now, the segment has this little, revenue growth versus cost kind of thing, which is mainly just hiring people. It's people business, not an asset business, really. But I think there's a very nice, the core, this business is already growing, like say 10% top line. If you actually throw like an M&A pipeline, and there is a lot of these companies out there that you could look to roll up. There are a lot of these companies that would roll up. Like you could easily push this to like a mid-teens. You're taking all the free cash flow, but like you could definitely see this thing grow 15% top line in like 15% non-cyclical top-line growers do not trade 15 times earnings. That is
And most importantly, the M&A should be pretty accretive because A, you're buying, there aren't a lot of other buyers for smaller companies in this industry, you would think. And B, you should, as you were alluding to, they should have fantastic synergies, right? Hey, we're
yeah.
going to buy you. We're the largest player in this quirky industry. When we buy you, if you're a one-off sterilization facility, we plug you into, we deal with every single major medical player in the world. We plug you into all of them to fill your supply. If you're just a quirky little consulting set, well, we have reputation, we have relationships with every major medical person. You might only be working with one or two. So you should have
Mhm.
great like cross-selling synergies through those things. So all your M&A should be quite accretive if done correctly. But
It looks and has been, with notwithstanding the last 12 months, a very classic looking private equity roll-up strategy of you get the bulkhead going and then you
exactly.
just tuck them
Yep.
in at lower multiples. We trade at a higher multiple, and then there's a tremendous cross synergy across the assets. Yeah.
Last question I want to ask, and then maybe we can do last thoughts and wrap it up. One person did say, "Hey, we talked about the legal. You talked earlier about there's a trend towards outsourcing, both because it makes sense, it doesn't make your beer better, but also because you kind of want to avoid the legal headache. So why not put that on outsource?" One person did comment, "Hey, is pricing in this industry going to go crazy now that that legal overhangs over there? They used to take 3 to 5% pricing. Can they just start going back to customers and be like, hey, nobody wants to deal with this legal risk. We've got all these legal costs. Like, does pricing accelerate because just nobody wants to take on new risk from this?"
I think like that's definitely. I think that is a very high probability kind of event. I think it's very captive at this point, like demand wise. Um, yeah, I think the answer is yes, and I also think like it's one of those things. Like I think it's super high probability for all the reasons you laid out, but like you're certainly not paying for it anyway. So it's
Yep.
like you don't need to talk me more into wanting to own Sotera at $17 a share. But
Cool. Look, I think we hit everything. I think hopefully we've covered great business, reasonable multiple, potential catalyst, legal situation. Anything we didn't talk about here that you think people should be thinking about, or that you kind of think about with the company?
no, I mean we didn't talk about Norney and Nelson, but I don't
Small
think.
pieces of the business, and yeah.
I think that I mean they're pretty fun and interesting. I particularly like Norney. I think it's just a fun company.
Hey,
Um,
anytime you can deal with Russian nuclear waste, why not? Why not get excited about it, right?
yeah, exactly. Yeah, no. The only other final thing is your mustache. We haven't addressed your mustache yet.
The classic elephant in the room. I shaved it yesterday. I had meeting up with a group of guys. I thought they would be figuratively tickled by the mustache, so shaved it and thinking about keeping it for a while. I was telling you before, I can only see above your mouth when you popped on the Zoom, and I thought you were joining me in the mustache crew.
I try to shave my face one time a year to just keep track of what it looks like, and I do a little mustache then. So,
Next time you come on the pod, when you come on for the fourth appearance, I expect you to have a mustache to join me.
sounds good. Sounds good.
Cool. Well, hey, Chris, this has been awesome. Appreciate you coming on. I mean, look, you and I, we've been following it for a while. You more successfully than me, but this is a really interesting story. And I'm with you. I think this is a great business trading at a reasonable multiple. And I think you just get a little tailwind as people get more and more comfortable with the legal overhang being behind them and the results produced. And it's hard to see how the results don't come in at this point.
Yeah, absolutely.
Cool. Well, Chris McIntyre, thanks so much. And we will chat soon.
Yeah, sounds good. Appreciate it.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.